Substantive analytical procedures are substantive tests, and thus the objective of these are to gather enough evidence that the account balance or class of transactions being tested does not contain any material misstatement. ISA 520 paragraph 5 sets out the factors that you need to consider when designing substantive analytical procedures. These include the suitability of using analytical procedures as evidence-gathering tools for a particular item being tested, reliability of the data that will be used in substantive analytical procedure, whether an expectation or prediction can be made, and whether any deviations or differences from expectations or predictions would be acceptable. Let's break these components into smaller elements. When considering suitability of a substantive analytical procedure, we need to think about the relationship that exists between the data. For example, there is a direct relationship that exists between GST and the amount of sales made. Suitability also requires us to consider the ability of substantive analytical procedures to pick up or detect misstatements. If the analytical procedure is not really going to be effective in identifying misstatements, then it would not be suitable as an evidence-gathering tool for testing that particular item in question. Reliability requires us to consider the source of the information. In other words, where is that information coming from? We also need to consider the ability to compare the information with other available data like industry norms. For example, which of the following would be more reliable? Management of the entity telling the auditor that the company pays interest of 5% on its loan, or obtaining the interest rate directly from the bank or by inspection of the loan agreement. Obtaining the interest percentage from the bank or from the loan agreements would be much more reliable than from representations made by management of the entity, as these are subject to fraud or error. That is, the management of the entity would be more inclined to give a lower interest rate charged in order to reflect a better financial position. When assessing the ability to create an expectation, we need to consider the ability to accurately predict the result. For example, the ability to predict annual rental payments that is fixed every month is going to be much more accurate than the ability to predict the annual repairs and maintenance expenses, which may fluctuate throughout the year. When creating an expectation, we also need to consider the aggregation of data. The more aggregated the data, the less able the auditor would be to identify material misstatements. This is because significant movements may be offset against each other when aggregated. For example, assume that entity A has a large number of fixed assets with similar depreciation rates. During the year, a major asset was sold and thus no longer depreciated. The accountant incorrectly used a higher rate of depreciation for another major asset, and so a higher depreciation expense was charged for that asset. If the auditor were to predict the depreciation expense on an aggregated level, the misstatement relating to the incorrect depreciation rate would not be detected, as this would be offset with the reduction in the depreciation relating to the asset that was sold. However, if the auditor were to predict depreciation expense for, say, each category of fixed assets, the auditor would be more likely to pick up the misstatement. When creating an expectation, we also need to consider the availability of data. For example, imagine you have been asked to create an expectation of what the annual office stationery expenses for entity X should be. Management of entity X is unable to give you financial data relating to the general prices of certain inventory items, nor are they able to provide non-financial data like the specific types of stationery that the entity would likely be spending on every month. In this case, the data is not available, and so it is almost impossible to create an expectation. The final factor we need to consider when designing substantive analytical procedures is the acceptability of the difference between the expectation we created and the actual amount. To recap, when designing substantive analytical procedures, there are 4 very important factors that we need to consider. These are set out in ISA 520, paragraph 5.